Hello, this is Professor Hazara, and this is the week of whatever, early February, let's say, because I'll be using this video next year too. These are brand new videos. Anyway, this is a week where, if you look at the textbook, and the way I have always done this is that you review financial statements. Now, a lot of the financial statements in the text are so basic, you just read the text. It's counting 201 basically. But there are a couple things that I'd like to review. One is the statement of cash flows. You can't get enough of the statement of cash flows. And I've also seen in the past a lot of people forget how to do a statement of cash flows. So this will be good for as a basic review for the CPA exam. And I'll put up a bright safe problem for you on the statement of cash flows. And the other one, so there's going to be 3 short videos on the statement of cash flows. I'm learning to make them short. But they're going to be, if you put them together, they're going to be one big problem on the statement of cash flows. And then I'm going to do one simple one video, which is sort of a topic that they also talk about in the chapter, which is just the articulation of financial statements. Now, that's the easiest thing on earth for anybody using a master's degree in accounting is how does the income statement relate to the balance sheet, the statement of cash flows. But I'm going to do it within the context of Microsoft because I want to make sure that you're not just learning how to read textbook type financial statements, but also the real thing. Okay, so anyway, and these are important before we get into other things, obviously, to more complex things. So let's start with the first of the 3 videos. The first of the 3 videos, the statement of cash flows. First video, I'm talking about the format. Second video, I'm going to talk about some of the calculations that you do before a statement of cash flows. And the final video, I'm going to talk about the statement of cash flows itself. Okay, now, this is a format, the statement of cash flows. And obviously, they can be different. I want to emphasize every one of these statements of cash flows can be different. So, don't memorize this. It's you know that this is a basic version of the statement of cash flows, a basic example. But in real life and on CPA exam problems too, they're all different. And I may give you one for homework that's a little bit different too. So let's get into this. Okay. As you know, statement of cash flows has 3 sections: cash flows from operations, cash flows from investing activities, and cash flows from financing activities. So you have those 3 sections: operations, investing, and operations, investing, and financing sections, and of course the bottom line of the statement of cash flows equals the change in the cash balance. Okay, now let me just go over each one of these sections, the way they're generally built. Now, each company is different, but they're generally built this way. The operations section summarizes, as I say here, the section of the statement of cash flows. The operations section summarizes the statement of company's cash flows from operating their business, not from issuing stock, not from issuing bonds, not from investing in big assets or divesting itself of big investments. This is simply from ongoing operations. Okay, so you always start this with a net income, which would be a plus, or even a net loss. It could be a minus. So this comes from the bottom line of the income statement. Plug right into there. Okay, then we have, if you recall, your adjustments to current assets and current liabilities. Now, I'm not going to go back through. As I talk through the problem, I'll give you some common sense things, but by now you should have an idea of why we do these adjustments. I will talk about a little bit about these gains and losses, depreciation, these gains and losses down here. But anyway, so you start with net income, and then as you should recall, this should all be reviewed, you have your adjustments for assets and liabilities. And always remember that the adjustment for assets goes in the opposite direction of the change in the asset. So for all assets, for current assets and all assets. Okay, so you're always going to subtract increases in current assets. So just remember that the adjustment for assets is always the opposite of the direction of the actual change in the asset. So if it goes up, you subtract it down. And you add back any decreases in the current asset. So if the current asset goes down, you add it back. So always remember that the adjustment here is opposite. Adjustment, I just call it's an opposite adjustment. And this is an opposite adjustment. Okay, for liabilities, both current, all liabilities, and anything on the right-hand side of the balance sheet. But for current liabilities, if they're on the right-hand side of the balance sheet, the adjustment to the current liability goes in the same direction as the change. So if the change here, it says you add an increase in current liabilities. Okay, Current liability spelled with 3 R's there, by the way. Anyway, so if a current liability goes up, you add it back. If any current liability goes down, you subtract it out. So I call these corresponding adjustments, meaning that if it goes up, you add it back. If it goes down, you subtract it out. So those are corresponding adjustments. Okay, now you always add back depreciation expense. That's always added back. And you should know by now that you do that because it's a non-cash expense. Depreciation expense, it decreases your net income, but no cash goes out. It's a debit to expense, which decreases your income, but you credit accumulated depreciation, so there's no decrease in cash. Now, I'm just going to tell you these, and then I'll explain more about gains and losses, because I think a lot of people come into this class and don't realize why we're subtracting out gains on the sale of assets and adding back losses on the sale of assets. So just remember those for now, but I'm going to sort of subtract them out, and basically all you're doing here is zeroing out gains and losses from their income statement effect. Okay, so this should be a review here. Start with net income, adjust for current assets and liabilities, with the assets being adjusted in the opposite direction and the liabilities being adjusted in the same direction. Add back your depreciation or amortization expense if they're intangible assets. Subtract out gains on asset sales, and add back losses on asset sales. And that should give you, and there's, in real life, and even, the CPA exam, there's going to be other things, like maybe there's an equity method problem or something, or the company had the equity method, which you would adjust because the equity method, you recognize the other company's income, but there's no cash coming in. So you would subtract that out. But anyway, so there's all types of adjustments. We're sticking to the basics here. Okay, now we come to cash flows from investing activities. And this is the one where it's very simple, but people get lost. There's two activities which are investing activities. And I say it right there. This section of the statement of cash flows includes cash flows from, one, the sale and purchase of long-term assets. So that's just one activity. There's only two things that go in here. Sale and purchase of long-term assets. That's the first thing. Okay, and the second thing is cash flows from loans made to others. Now, I want to be very specific about that. These are cash flows from money you lend out, not money you borrow, money you lend out. So the two activities here are the cash that comes in or goes out from the sales and purchase of long-term assets, and cash that comes in and goes out from loan activities. Okay, now, what I like about both this section and the next section of the statement of cash flows is that each one of these items of these two activities, each one of these activities has a sort of an opposite, equal and opposite, sort of a mirror image cash flow. Okay, so the first activity is sales and purchases of long-term assets. You're going to have a cash flow from that activity, and you're going to have an outflow from that activity. The inflow, you think of sales and purchases of long-term assets. Well, obviously, the inflow is the sale of long-term assets. The outflow is cash paid to purchase long-term assets. Now, I'm going to see here if I can go out here and put a line here. I don't really there. Just put a line there to fill that in there, and also here. Put a line here to fill that in there, because I want to emphasize that those are separate activities. Okay, so anyway, you have two activities here: the sale and purchase of long-term assets and loans made to other entities. Not money you borrow from other entities, but loans you make to other entities. So each one of those, activity number one, sale and purchase of long-term assets, has an inflow and an outflow. And this is pretty obvious. The inflow would be the sale of assets, and the outflow would be the purchase of assets. So activity number one is just, they're mirror images. You either sell something here, which would be an inflow, or you buy something here, which would be outflow. Okay, the second activity would be flows from loans that you make to others. You could call it lending activities. That's a pretty good description, actually. Okay, so what would be the inflow flow from lending activities? When people pay you the money back, they owe you the money and they pay it back to you. That would be a loan. That would be the cash inflow from loans that you make to others when they pay you back. What would be the cash flow? When cash is loaned to others. Okay, so but think the big thing here is this activity is loans you make to others. The inflow is when they pay you back. The outflow is when you make a loan. So just remember there's two activities in investing activities. One is sales and purchase of any type of long-term asset. It can be a fixed asset or it can be a long-term investment. It doesn't matter. But the proceeds go right here. Okay, so the proceeds from the sale are an inflow. And obviously if you buy them, they're an outflow. And when you lend money out, when you're thinking of lending activities, the outflow is when you make the loan. The inflow is when somebody pays you back. So it's pretty simple. Okay, finally, kind of the same thing here. Financing activities. For financing activities, there's two ways in traditional simple corporations to raise capital, which is financing. One is stock, issue stock. The other one is you issue bonds. So either and you know that's why we have long-term liabilities and equity on a balance sheet. So you associate this section with the bottom of the balance sheet, and here's what we got here. There's two activities here. These are ways that you finance your own long-term operations, not your sort of ongoing short-term operations. That's operations, but your long-term when you buy something big like equipment or something along those lines, or you buy another company along those lines. Okay, but just like investing, there's two activities, and there are equal and opposite inflows and outflows. Okay, the first one is issuing and buying back stock. That's just stock. That's one way to finance. Okay, so that's the first activity. And the next one has to do with borrowing activities, money you borrow. Okay, so while loans that you make go in investing, money you borrow goes in financing. And that's where people get lost, because they always get lost between a loan made to others and money you borrow from others. Loans go into investing, borrowing comes here. Okay, so and just like the previous section, each one of these two activities here, number one and activity number two, have an equal and opposite inflow and outflow. Well, the inflow, let's think of issuing and buying back stock. The inflow is from proceeds from when you sell stock. When you sell stock, money comes in. The opposite outflow is cash made to repurchase stock. And I also say pay dividends. And I'm going to talk a little bit about that one. I'm going to talk a little about Microsoft in a short video on Microsoft here. But stock buybacks and dividends are kind of the same thing. The company has extra money, so it can pay you dividends, or it can take that same cash and buy back stock in the hopes that your stock price will go up. So in a sense, they're kind of the same. And even in some statements of retained earnings, statements of stockholders' equity, they're considered the same. You're going to see that in Microsoft. Anyway, so when for stock, it's pretty obvious. You sell it, cash comes in. You buy it back or pay dividends, cash goes out. That's the first thing. The second activity here, you could call it borrowing activities. What's the cash inflow from borrowing? Well, when you borrow it, cash received from borrowing from others. And what is the cash outflow? I'm going to say here repayment. I'm going to say repayment of cash borrowed from others. I think that's the best way to put this here. See where that line came out here. Right about there. Okay, but so keep in mind there's two activities here. One is issuing and buying back stock. The inflow is you issue stock. The outflow is you buy it back or pay dividends. And then next activity is borrowing activities. The inflow is you borrow cash. The outflow is you repay the money you borrowed. Payment of cash borrowed from others. Perfect description. That'll give you from cash flows from financing. I'll just say financing here. Put the wrong thing here. That'll give you cash flow from financing and sum up 3 sections, and that should give you a change in cash. Okay, so let's go ahead and I will stop this video and I will put it up. Only 14 minutes. Very good.